All right, great. Welcome back to another episode here. We're sitting here one day before Jackson Hole. Market sold off. What are we at? When is it? Are we really on 5 days in a row?
Kind of, yeah. No kidding.
All right. Yeah. All right. So yeah, we're looking at a chart of the S&P, breaking down a little bit here. Broke the 10-day moving average. The real kind of carnage has been in the momentum names. Again, we got Jackson Hole tomorrow. My thinking is, everyone knows heat formula hedges, always have hedges. I have more hedges right now than kind of my base case going into Jackson Hole. I read those Fed minutes that came out yesterday, and I understand that those were prior to the jobs number, but those look like very hawkish minutes to me. I think if Powell does not clearly signal, yeah, we're going to cut in September, I think that could be a problem for the market. Yeah, I'm not betting that they're not going to cut. I think you're better off being a little bit more hedged into this event than not. What are you guys thinking?
Can I add? On the last episode, Matt, you said you had shorted some SARK as a hedge. Good call, I guess. Is it still in there?
No. I will never touch SARK.
Oh, no, ARK, not ARK. SARK, ARK, ARKK.
Never say that word on this podcast.
My bad. ARK.
Yep.
Right. Yeah, no, I still have my ARK puts. I also sold some calls on ARK. I still have those. Those are doing very, very, very good. And the reason why I did that is because my sense was the momentum, ARKy names were going to do a whole lot worse than the S&P. I still have some S&P puts. I did a put spread today on the S&P. I also did a calendar spread on the S&P this morning. But if this market comes down, the ARK names are going to get crushed. So yeah, I'm not covering that until I see what happens on Friday. And then I'll also see what happens with follow through on Monday, because sometimes, on any type of Fed day, which I would classify this as, when people have time to sleep on it, they sometimes come up with a different opinion. So I don't think I'm doing anything with my ARK stuff until Monday at the earliest.
So one more thing on ARK, right? I read last week it had like record inflows on a Tuesday and like record outflows on a Thursday or whatever. Any thoughts on that? We got Larry from Blue Chip Daily on here. Any thoughts on that, either Matthew or Larry?
Yeah, my thoughts on it are people are using it the way it should be used, is as a trading vehicle.
I got it. Okay.
Back in the day, people were using it as a buy and hold long term, and it is one of, if not the biggest destroyers of wealth ever. A lot of us are close to the same age. There were a family of mutual funds at one point. I'm blanking on the name. It started with an S, that I think was the worst wealth destroyer ever. There was an article in the Wall Street Journal that said, anyone who's still a shareholder must be dead, because it just doesn't make any sense. So, yeah. ARK is probably second to those guys.
Wow.
Right.
It's like Lehman Brothers stuff.
Yeah.
Oh.
Yeah, I remember back in the day that Janus 20 fund, that was a tough one too.
Well, yeah, during the internet crash, I started off. So I started investing in like 1981, and I'm pretty sure I was putting money into one of the Janus funds. Janus 20, it may have just been the Janus fund. Janus 20 may have come out later. I don't remember. Right. Luckily, I didn't still own it in 2000.
Right, sure.
And I.
Larry, what are you seeing in the market here?
So right now, I'm prepared for some shorter term volatility, maybe over the next 4 or 5 weeks. So a couple things. Seasonally, this is the worst time of the year in the S&P 500. I saw a statistic the other day that since 1950, on average, the S&P 500 is down. So, I've still got some fresh memories of September 2022. So I'm a little more cautious going into September just seasonally. But then on top of that, the market is pricing in a Fed rate cut. The Fed funds futures are at about 80% or so the last I looked. But the issue is, I don't see the Fed rate cut because, based on inflation, we just had a hot CPI number, year over year. We had a hot PPI number, PCE, which is the Fed target, that's still well above the 2%. And really nothing that the Fed has said, including in their last meeting, nothing that the Fed has said to me, especially Powell, indicates that they're ready to cut in September. So the markets really seem to be embracing that. And I think the setup there is, if for some reason, like what Matt said, if for some reason Powell comes out hawkish tomorrow or the Fed doesn't cut in September, I think that the market, reacts pretty sharply to that.
Wow. If you guys hear some beeping in the background, that's me buying more ARC puts.
Right. So Larry, you said earlier about home builders off camera, I think like that's been a good performing sector of late. So
Yeah.
how does the rate cut affect that?
So
And
that's
no
gonna
rate
be
cut, I guess.
Yeah, that would be one of the more volatile sectors. So since July 1st, the home builders, XHB, the ETF, DR Horton, Lennar, Toll Brothers, they've all been really strong. And I think that they're front running, expectations of a Fed rate cut. So I think that's going to be one of the more volatile markets based on the Fed rate cut expectations. So the market, I always defer to the fact that the market is smarter than me. And in the past, I've seen these trends start to develop. And, I'll look at the trend. Like if you look at XHB, especially since July 1st, you see it had that big breakout bar on heavy, heavy
Excuse
volume.
me.
It's been trending higher since then. And, for whatever reason, the market is buying into this rate cut. So it's going to be more volatile. If they don't cut, XHB comes, right back down. But there's a lot of institutional money moving into that.
So Larry, you talked about trends. Why don't you step back? Tell us your investing style. I know you're a trend follower, but
Right.
that means a lot of different things to a lot of different people. So what is it that you're looking at? How do you invest?
Sure. So I've got an intermediate to longer term time frame. So short term for me is the 3 to 6 month window. 6 to 12 months is my target window. And what I look for is bigger long term trends over the 50-day moving average and over the 200-day moving average. So I'm looking for, big trend moves, 10, 20, 30, 50% moves. I'm not as concerned with the 3 to 5% consolidation, but I'm looking to buy into some big moves. And as long as they keep working, like I've been, heavy in AI stocks since May 2023. So as long as the trend keeps working, I want to stay with it, as long as it's going.
And then what do you look at to get out of markets, and do you ever short?
I don't short. The way that I get defensive is I'll just raise more cash. That the cash for me, is really the best volatility hedge. So I really don't short anything, but I'll move to cash. I'll move out of some higher volatility ideas. And the key thing that I look at is number one, just the price trend, higher highs, higher lows. If you take a look at this XHB chart that's on the screen, you can see since the lows in April, you've got basically a series of higher price peaks. You've got a series of higher lows on the chart. You cleared the 200-day moving average in July. The 50-day, which is the blue line, turned up, and now it's just crossing the 200-day. So all of those things to me are bullish trend signals.
And are you looking at anything fundamental or macro, or is it just purely this is in an uptrend and I'm getting into it?
I do pay attention to the macro for how I want to get positioned risk wise. So like right now we're talking about the Fed, we're talking about seasonality. So I definitely pay attention to that. I try not to front run Fed meetings. I try not to front run, the CPI report, things like that. And I do in my stocks, I take a look at sales growth and earnings growth. So ideally, if I can get a stock that's breaking out in an uptrend, and I've got above average sales growth and I've got above average earnings growth. That's what I really like to see. So I go with a lot of momentum names, stocks like Nvidia, Palantir, Robinhood, GE Vernova, the nuclear stock. So I'm looking for a combination of a strong chart and strong fundamentals, but I will take a strong chart that doesn't have great fundamentals.
So that's interesting. And why I said, I mean, trend following means a lot of different things to a lot of different people. You see a lot of people on social media who are more kind of Bill O'Neill type followers, and they seem to end up in a lot of the memeier stocks. And it seems like you're in more of, again, the Nvidia, the Palantir. I mean, for lack of a better word, the more established companies versus some of these high flyers that triple in a week and then come all the way back down. Is that by design or what?
It is by design. So there's a few things. I started to put together some rules-based trading principles about 20 years ago for myself. And what I used to do, I used to overtrade quite a bit. So the first thing I wanted to do is I wanted to set a specific tradable universe. So I experimented with it a lot and I landed just on large cap stocks. So any stock that's over $10 billion, there's about 880 large cap stocks. And what that allowed me to do is really focus on the same group of stocks all day and not be, screening through 2,000 stocks or 3,000 stocks. And the other thing, like what you brought up, so I use hard stop losses in the system. And the problem with some of these meme stocks and some of these small caps is, you can take a position, it can have a 10 or a 15% drawdown, get stopped out, and then the next day it's up 30%. So in order for me to run my stops, I really look for the, larger cap, a lot of volume, a lot of institutional names where they don't have those wide, stop loss hunts every single day.
And then your portfolios, I think, tend to be fairly well diversified as well. Like what's kind of your max position size?
So my max position size on a single stock, I'm going to try to stay at about 5%
Okay.
on the high side.
Cool. Yes. I mean, you see a lot of people out there who, maybe they'll have like 5 stocks, 20% each. And, to me, that's fine if you've got like a $10,000 account. But,
Right.
Anything over and above that's way more volatility than I like.
You know what it is? So obviously, I've got a subscription-based service. I've got a research newsletter, and I've got a lot of professional, fund managers, registered investment advisors, institutional managers, things like that. So what I do is I gear my approach towards basically the type of funds that they're managing. So like you talked about that, that 5 stock, 10 to 20% in each stock, that's a great swing trading approach. But really, the focus of what I do is more institutionally based.
Makes sense. Pat, you wanted to ask a question?
Well, I mean, obviously I always do, but all right. So is this a fair question? Do you believe we're in the middle, early, late stage of the bull market here?
I believe in the stages? I
Do you believe yeah. And so therefore, where are we, do you think?
I don't know the answer to that. And I'll tell you why. If we avoid any type of a recession or if we avoid any major breakout in inflation, then I think we're probably, 6th inning, 7th inning, something like that. But I just can't, we can't forecast. I do have some concerns about inflation because it was going in the right direction for about 3 or 4 months and then it started to tick higher. So if we get a big breakout in inflation, then I think, it sets us up for a pullback. But as far as the secular trend I think we're probably in the 6th or 7th inning.
And Pat, I'll push back on that from the standpoint of I don't think that matters at all. And I don't think it matters at all because no one has any idea, without hindsight. So, one of the things I always tell people is trade what you see, not what you think. And, so we kind of trade what's in front of us. Right now the market is going up. I think you need to be cognizant of all scenarios. I saw a guy in a podcast last night. He made an extremely compelling argument for a 70% drop in the market. Is that going to happen? No idea. Will that happen at some point? Sure. We saw 60% in 2008. We'll see that again. No idea when that's going to happen. So, for now, the market's in an uptrend. I'm taking risk off the table ahead of a massive market moving event, which I like to do. But you've got to have, in my mind, an investment philosophy. And I wrote about this a little in our newsletter this morning. It cannot be set it and forget it. It can be set-ish and forget-ish, where you've got a philosophy, it's an all-weather philosophy, but you've got the ability to tweak it based on what you're seeing. Because again, I don't think anyone has any idea, what you've got to be lucky to be right as far as, what inning we're in. And, one of the things that's having the Fed have pause is uncertainty around tariffs. And, that uncertainty is real. We have no idea.
Yeah,
Okay.
I have something to add to that, actually. Trade what you see is indeed ingrained in my mind because I'm a technical analyst guy. If you pull up the SPY chart, I'll point something out that kind of stands out to me. And then when we say things like the Fed is uncertain, so is the market. And what I'll point out is if you look back to about the beginning of July there, and you move to the right in the chart, you'll see we got a broadening pattern. Typically, we see those when the market is starting to become uncertain. Sometimes the tail end of that will come to a point where things start to compress, the range starts to get tighter. When I see that at the top of a trend as a technical analysis thing, typically the bias is possibly set up for a pullback. So uncertainty kind of leads to that in the technical analysis. And being that the Fed's a bit hawkish on this, we're going into a little bit of uncertainty. The market's a bit uncertain. Sorry about the barking dog. That kind of concerns me. And if you look at where that ends up coming to a point, if you were to map the high back to the beginning of July and then move it forward, it ends up right in about the first week of September. So I think we are going to see something, some sort of catalyst kind of take some volatility back into the market in mid-September, just from my observations.
All right. Okay. So I'm going to say something. So just so you guys know, Larry is from the Blue Chip Daily. Made a massive bullish call, 411.25. It's great. Home run. Also made a massive bullish call on artificial intelligence in May of 2023. So it's pretty good. I'm going to ask you all three of you guys a question here, right? So you're all technical experts. You all use the 200-day moving average. That's right.
I look at it.
That's like the main one you use, Larry?
No, the main one that I really use is the 50-day. So I look at the 200-day for the longer term trend, but really the 50-day is my sweet spot.
I see.
Yeah, I look at 10, 20, 50, and 200. I don't really have time to trade anymore. But occasionally I will still look at those charts for timing help on different things. And there still occasionally are, trades that I'll take and I'll look at the charts. I'm somewhat, I think, different than Larry in that I'm much more comfortable as a counter trend guy. So I'm not looking for breakouts necessarily. I'm more looking for I love undercut and rally patterns. That's the type of stuff I love to see. And that's not saying that that's better than buying breakouts. It's saying psychologically, I prefer buying something on sale than buying it when it's already up. Um, yeah, but I think both methodologies have merit.
Right.
Sure. Yeah, I think it really comes down to each person's time frame, mindset, things like that, and everyone has to really do what works best for them because you can make money Matthew's way, you can make money my way, you can make money whatever we do best. I think is where we should focus.
Yeah, there's no one right answer. There's a lot of wrong ones.
Yeah.
So as long as you stay away from the wrong answers, then you can do well in markets. It's not, I hate to say not that hard, but I mean it's not that hard. You've just gotta do the right things.
Right.
I think too it's a lot about consistency. Because if you could make money if you only bought and sold stocks that traded with the letter A, if that's what you focused on every single day. So I think if you figure out what you're good at and then you do it consistently and you don't try to be, a day trader one day, a swing trader the next day, a trend follower, I think if you just stay in your lane and you're pretty good at it, then you can make money.
And that's an awesome point. And one other thing I will mention, because I think it's important, is understand that's harder. That's a lot harder than it sounds, because whatever methodology you use will have periods of drawdown.
Right.
And it is very hard to stick with something when it's drawing down and you start to question, hey, is this really, a good methodology or not? I mean, maybe I was wrong. Maybe this is better. And you see, oh man, I'm in a drawdown, but Larry's killing it.
Right.
Maybe I'll switch from doing what I'm doing to what Larry's doing. And then Larry goes into a drawdown. So I go, oh my God, now what am I doing?
Right.
Once you go
It's
down,
the sand trap theory, you just
Right,
gotta
I mean,
pitch it out. You can't like try to get over the
once you
10
go
foot
down
lip.
that rabbit hole, it's the kiss of death.
Right.
Guy called me the other day, systematic strategy wants to launch an ETF. And we've done a lot of those for people. And one of them started down that path and I just knew they were cooked.
Good
Right.
point. As you may know, we do this live, so we're kind of unscripted. I actually have a user commenting on our YouTube channel here. Goes by Investing Perspective, asking a question for Larry. It says, how do you identify leaders and sectors to get long?
So a couple things I do. So every single day, I'm screening for the highest relative strength stocks, and I'm screening for stocks that are closest to their 52-week highs. So that puts me number one in the strongest momentum stocks. And then if I see a group of stocks, let's say, all the nuclear stocks are near breakouts or all the semiconductor stocks are near breakouts, then what I'm going to do is I'm going to look for the strongest stocks in the strongest sectors.
Very cool.
I'm going to ask you a question, and this is a little bit IPO, a little bit crypto. It's like, how do you evaluate like a new asset class? So let's say a Figma comes out. I mean, you can't really trade it until it has an established chart pattern, or how do you manage something like that? Or let's say crypto, I'm not sure. It's just a broad kind of question.
Yeah, no, I don't do too much with IPOs, but if I was looking to, I'd wait till it had at least a 10-day moving average. At least if I've got a line on the screen that I can trade against. And even if it's a 10-day, I say, okay, the stock is below the 10-day. I don't want to touch it. And then if it breaks above the 10-day, I could consider that a buy signal. So I'll use the moving average as a green light, red light type of a signal. And if it's below whatever moving average I pick, then I'll generally stay away from it.
Right. I see.
And I would throw in that's probably really, really smart from the standpoint of when these things come out, there's no edge. I mean, the only edge is in getting IPO shares.
Right.
Once these things come out and go up 300%, then it's a crapshoot. I mean,
Right.
you've got no, there are no levels at that point. There's no support. There's no resistance. You're throwing a dart at the board. And if you make a whole bunch of money on a Figma, you're going to lose it on a fly or, something like that. So, I think that's great advice for people out there because you'll see these IPOs come out and then it'll still double off the IPO price and you got FOMO. But, again, from my standpoint, going back to the heat formula edges, there's no edges in throwing a dart at an IPO chart that's going crazy and trying to hit the right spot.
I digress a little bit with that because I still do a little day trading. I actually use an 8-period moving average for especially volatile stuff like that. But you're absolutely right. You can't have any hedge unless you at least establish some history so you can know where the buyers and sellers are, where the range is, and all that stuff. You got to be able to identify that. I just use a little shorter time. But when you're looking at, following through with an IPO, it's always going to be dangerous. You have no clue where they're going to go. And in my philosophy, I always know that, when the market seems to make an impulsive move that seems impulsive, at least in most IPOs, they have impulsive moves. They tend to give half back at some point, and it's pretty typical. So you can have an edge with that, but it doesn't make you an investor. It makes you a trader. And there's a time and a place. So blending those skills is where you really want to be.
So you're using like the 50-second moving average, right, John?
No. I go with an 8 period, and it's just 8 candles. I trade naked anymore anyway. I mean, my charts have like no indicators on them. I just
wait, what?
Yeah, trade naked.
All right, dude. I don't want to get into that. That's fucking.
All right, this is not a closing
No.
podcast. We're gonna make you wear a suit and tie next time.
Okay,
Larry.
not physically naked. I trade a naked chart. But yeah.
So Larry, you brought up NLR, right? Which isn't that the nuclear ETF? In one of your I don't think you're very bullish on this one, no? Can you pull that one up, man?
Not right now. So NLR, I took it off our weekly buy list on Sunday. So it's been really strong, but it broke below the 50-day. I think a couple days ago. I'm just waiting for the chart to come up.
Yeah.
So it broke below the 50-day 2 days ago. I actually took it off our weekly ETF buy list this Sunday because I didn't like the way that the chart had been rolling over. But it's been on the buy list mostly for about the past 3 months or so. It's been one of my favorite sectors. But the way that I use that chart is once it loses that 50-day, and it's held the 50-day for 4 months. So to me, that's a bearish trend signal. And that tells me, okay, there's something different about the momentum in this chart today than over the past 4 months. So what I'll do in a situation like that is if I had a position, I would either sell it or I'd cut half of it, something like that. But no, it's not on our buy list right now. It could go back on there. I'd like to see it get back over 115. It's still one of my favorite long-term groups, but if the market has any weakness, into the Fed meeting, then, this is one that's going to sell off pretty fast.
BWXT ever make it on your radar screen?
Yeah, BWXT. So I actually just posted on it today on the Twitter page. And this is one of my favorites. It was on our top 25 list before that earnings breakout. But the thing about BWXT, they're in nuclear, but they're also in defense. And nuclear and defense are both two really hot sectors in 2025. And this is still holding over the 50-day. So, it could consolidate, and it has over the past 2 weeks after that big earnings breakout. But this is one of my favorite stocks in that sector.
Yeah, no, me too, which is why I brought it up. To me, a lot of these small nuclear companies are extremely speculative versus a BWXT, which is actually a real company. It's not going to move, what's your one, Jeremy? LTBR?
SMR?
Yeah, LTBR is going to be volatile for a long time.
Yeah, that's a roller coaster ride.
It's great for traders, but investors take heed on that one. You don't want to be someone else's exit liquidity. Let's just say that. And then recently, SMR is what I'm really watching. That seems to have a better future in the long term.
You know what it is? SMR. I think it hit the SMR has real sales and earnings, I believe, but that one's been rolling over. But like
Yeah.
Oklo's been a home run stock in
Oh
nuclear
yeah,
year to date, hit the 50-day, but they've got no sales.
right.
Like as far as I understand, they don't even have any sales yet. So like what Matthew was saying is BWXT, they've got real sales, real earnings, things like that. So a little bit less speculative. BWXT is one of my favorite stocks in that group.
And the thing with SMR is, I mean, they're more the modular, smaller nuclear power plants, and the idea is, of course, the data centers are going to be grabbing them up. Realistically, we've had these things for eons. They're in every nuclear submarine, battleships, carriers, and all of our nuclear powered fleet. They run them, problem free in all kinds of crazy conditions. So the stability is there, and it's something where all the engineering is ready to go. They're all the same. If there's a problem with one, you know where to look on all the others. It kind of makes sense for modular nuclear versus the massive structures. So depending on what it is, though, I mean, if you want to power, entire states or bigger areas, yeah, of course you need some bigger plants. But for a lot of this stuff that's in demand in close proximity, SMR. So that's going to be a fun sector to watch altogether. And stability, you're going to see it in the bigger companies. Volatility for now, you're going to see it in the smaller companies, obviously. But where's the end point where these start to stabilize? That's a good question.
Yeah.
So Larry, speaking of defense, you were in one of our names, EUAD. This is the, what do we call this? The European Aerospace and Defense Fund?
Yep, Europe Aerospace and Defense.
Yep. What do you think of this one?
So I like it. It's consolidating right now. I think Europe is bullish. Aerospace and defense is bullish. I think this is fairly concentrated. I think the biggest 6 positions are like 70 or 80%.
That is correct.
Yeah, so a little consolidation, but I'm bullish on Europe and I'm bullish on defense. I really like Rolls-Royce, which is RYCEY, is probably my favorite stock in that ETF. Really strong chart, pulling back over the 50-day. But yeah, I think that EUAD is a long-term winner.
All right. So RYCEY, I mean, they compete with G. You also talked about GE a little bit too, right? Like the GE,
Yeah.
the aerospace guys, right?
Yeah,
So just
GE
straight
strong.
GE,
Yeah,
right?
yeah.
So it's kind of the
GE's
same biz as Rolls-Royce, yeah?
Yeah,
A little bit?
same thing. Rolls-Royce makes a lot of the the jet engines and the whole aerospace end of it. And yeah, very similar to GE.
Right.
GE also does, I mean, everything, even your washer and dryer.
I'm not sure these are the same guys anymore. I think
they
that's
split
someone
it.
else. All right. So how about TSM? You've talked about that a little bit. You were in there for the way up. I think you got out of it. Any thoughts on that guy?
Yeah, I took some off the table. So I was in it for the way up. I think I bought TSM coming right over the 200-day moving average back in May, right over that red line.
Nice.
And I sold some on the way up. I sold some a little bit higher than here, and I sold some yesterday. So generally what I do is, if I think a stock is a core stock, and I think TSM, is as strong of a company as it gets longer term. So I want to try to keep a position in TSM, but when the chart starts to break down, like yesterday, it gave a sell signal below the 50-day moving average. So I had reduced some a little bit higher. I reduced some yesterday. I think my biggest position in the stock might have been somewhere around 3% or so, maybe a little bit over 3%. I think I've got a 2% allocation. So generally what I'll do is I'll try to hold a core position, but then oftentimes I'll trade around it. So I might sell some on the way up, I might buy some on the pullback. But if I was shorter term, I would just sell it under the 50-day. But what I've done here is I've reduced it, locked in some gains, but I still want to stay long because I think that at the end of the year, TSM's higher.
Yeah, Matt, I look at all these, Matt, Tuttle, I mean, I look at all these charts here. And they all look like they're kind of set up for mean reversion if the market kind of stabilizes or bounces here a little bit. No, I mean, like all these, no.
I mean, that's what you've seen the past couple of days
For sure.
is, things selling off. And again, under the surface, it's more pronounced than if you're just looking at like, the S&P or the Dow. A lot of the stocks that have done very well, people are taking profits right now.
All right.
And the open question is this just normal? Because that happens. I mean, you look at you look at this chart or any chart, you don't go up in a straight line forever. You pause, you go sideways, you go down a little bit, and then you resume the uptrend. So what we're seeing could just be that. But also, if this is a top or the top, this is the type of action you're going to see as well, which is what makes it very, very hard because you don't know. I mean, I may have an opinion, Jeremy might have an opinion, Larry might have an opinion, but they're just opinions. Nobody knows for sure, and which is why you've got to kind of plan accordingly in your investments. And again, why, I keep harping on Jackson Hole, because, we're sitting here, people have been taking profits, and we've got a potential major market moving event tomorrow.
Right.
It's a risk off market for the moment until we get past Jackson Hole.
Larry, any words on PLTR? We kind of beat a dead horse on that on our last episode, but I told you I'd talk about it a little bit.
I've got a lot of words. So
right.
I've been lucky. I bought Palantir last September. It was breaking out at like $34. So it's been a nice long-term winner. I've actively traded around my core position. So, I've always had about a 2% position. I think it got up to about 5% position. So it's pulling back here pretty sharply. Big breakout after earnings. It filled that gap. And the key thing, it's like what Matthew said, the macro bus of the Fed outlook is really going to determine what happens to most of these stocks. Because where we're at right now is we're past the earnings season. So we got the big earnings boost, all the momentum from that. And now you're kind of like in a quiet period between there's no earnings, it's a weak time of year, and the Fed and the market is hyper focused on, what Jerome Powell's briefcase is going to look like tomorrow, and, what his opening word is going to be, things like that. And I think that's why you see that profit taking. So it's holding the 50-day. But, if I didn't have a position here and I wanted to buy any of these stocks, I would do it a lot smaller because, right now it's not the same market tone. If you look at the April chart, and it's easy to say it in hindsight, right? But, the trends are the same. In the April chart, you came over the 50-day, you had your 10-day cross the 20-day to the upside. You had a bullish breakout. So you had a lot of bullish trend signals on the chart. Now what you've got is, this 15% pullback or so, 20 days turned down, the 10 days turned down. So the trend momentum over the past week and a half or so is much weaker than it's been, since the middle of April. So I pay attention to, are we in a breakout accumulation phase, or are we in a pullback phase? And we're in a pullback phase right now. And that's where I want to be a lot more, diligent about managing my profits and not trying to take any big long bets.
So like position sizing. Yeah.
From my side,
Oh, yes.
we had an undercut and rally yesterday.
Yep.
So you see a massive knife through the 50-day moving average yesterday, and then it ended up closing back above. Now, as podcast viewers know, me and Steve Orr bought the dip the day we did that podcast, so we're both still down on our dip buys. I'm not going to buy the undercut and rally because, again, I'm trying to sit on my hands ahead of Powell, except for adding hedges. But if we didn't have Powell coming, that's a pattern that I may trade.
I waited for yesterday and caught the leg bounce off of as it came back through 146. I went with leverage and did my position, but everybody's gonna have a different entry on that.
Yeah.
And as far as we know, these undercut rallies usually have a pretty good probability of working out, at least back for a reversion trade or something like that. Look at the gap on the chart; it's pretty obvious.
Right. I was going to say something about position sizing. It strikes me. I know Matt's really good at that. It strikes me you're good at that too, Larry. So
I
I'll say
spent
that. Go ahead.
I spend a lot of time on it. It's really the basis to what I do.
Right. Yeah, makes sense. I can see that.
Yeah,
All right.
but and everyone's different there. For me, I'm using mostly options. So what I do is I delta adjust my options to make it look and smell like I've got shares,
Right.
and do position sizing that way. And for me with the options, it allows me to take the money I'm not using for the shares and I buy T-bills. So like 80% of my portfolio is T-bills, which is cool because I know if all my options go to zero, my max loss is 20%, which is way better than like 60% in 2008. But it also allows me, if I want to, which I'm not doing in this environment, to theoretically leverage and get to more than 100% equity exposure using options if I wanted to.
Right. So I'm going to come out from left field from back in the 80s. So Larry, you actually talk about like BTI and Philip Morris, MO. These are both tobacco guys. They've kind of bounced up and down a little bit. Where do you feel about those? I mean, you've been bullish on those.
Yeah, so I've got BTI. I've had it for a while. I sold Philip Morris too early. I made some money in Mo. BTI really is the strongest chart in that group. And if you take a look at it, just by using the moving averages, it's got higher highs, it's got higher lows. All four moving averages are rising. They're all stacked on top of each other. And I've got to say, this has been a surprise, performer for me because I think I bought BTI the same day that I bought CrowdStrike. And I wound up selling CrowdStrike probably for a scratch. And then, the tobacco stock, has been the winner there. And then Mo's very strong too. I had that. I made a little bit in Mo, but I sold it too early. I think I sold it in the 50s or so, and I think it's $58 right now because I just didn't want to hold two tobacco stocks because tobacco stocks generally are pretty slow movers. MO traded sideways for a while, but yeah, it's strong. BTI though really has been a surprise stock.
Right. It's
Yeah,
just like, what's the why on this? I mean, this is surprising. We're up from 38 to 58 in 4 or 5 months. Why are the tobacco stocks rallying? Trump related type stuff or?
No, I think so. When I bought BTI, I think both that and Mo, I think they both had single digit PEs, and I think they were both paying over a 6% dividend
Like
yield.
one's 10,
What the
10%.
PE?
I think the dividend yield is like 10 on Mo or was, something,
Yeah,
yeah.
it was, it was really high, So if you were just looking for a cheap, low PE, high
Okay.
dividend stock, and there might have been something else, Europe has been super strong. BTI's got some of that Europe exposure, so it could be that too, but it's been a great stock.
Got it.
yeah.
Okay.
This one pisses me off because it was brought to my attention months ago. I mean, probably in May, and just I like thematic names. I didn't see it, and yeah, never bought it.
All right. And what's
You
the
know, it,
theme? What's the theme here? Just tobacco is the
I
theme?
mean, tobacco. It just there wasn't. Yeah, I mean, tobacco didn't move the needle for me, unfortunately. And this would have been a nice diversifier because unlike a lot of the AI names that kind of topped out and haven't gone anywhere for a bit. I mean, this is a straight ride up.
Right.
Would have been nice to have in the portfolio, but no.
Right. Okay. Right. Yeah, I think there's like some new smokelessy delivery stuff coming out that I think people are excited about, honestly.
I mean,
I
there's
don't
the
know for sure.
pouches, there's all sorts of stuff.
Right,
I
right.
mean,
Okay.
tobacco, I think there's more and more coming out, not tobacco, but nicotine as a performance
Yeah, right.
enhancer, without the cigarettes. I mean, I personally use nicotine. I don't smoke cigarettes and never have, but nicotine definitely has, in and of itself has an effect. And I think science is starting to be okay with that.
Got it. Okay. So Microsoft, Larry, you said, or you kind of reposted some other guy said, is the only company that's been in the top 10 and the S&P 500 for 20 years. And we had another guy talking about this yesterday, Stephen Orr, or Tuesday. Any thoughts on Microsoft, you guys? I mean, what's up with that? It's been around forever.
They got it right. Microsoft was dead money for maybe 15 years. I think from like 2000 to like 2013 or so. I think Microsoft was pretty much stuck in a range, but they've reinvented themselves, as an AI company. Oracle is another one that was, Oracle was a kingpin back in 2000, then it sold off quite a bit. But I think Microsoft, they really have done well with, their AI business, and the market's taken to it. I missed Microsoft, because to me, I mean, it's a great chart, it's a great stock, but I only hold so many stocks. So I think, the max that I'll hold about 20 stocks. And I think I've got 20 stocks right now, and I probably have 4 or 5 ETFs. So in software, I've got Palantir, and then I had CrowdStrike, but I sold that. So Microsoft, to me, I missed it because I just didn't see the earnings growth compared to these other stocks, but it's been a super strong stock.
Yeah, come to think of it, Matt, you never talk about Microsoft. I don't think I've ever heard you talk about it once. Any real reason? Just too much, too
No,
big, too
no.
loose?
So my sense is that if you look at the Mag 7 and try to figure out who are going to be the big winners in AI, I think NVIDIA is number one. Right now, I put Microsoft as number two.
Got it.
So I do like Microsoft a lot. And theoretically here, you've got an undercut and rally at the 50-day, right? You look at the low today, 502.72, 50-day 504.14. We undercut, we rallied back above. So again, if we weren't sitting on Powell and the market didn't feel toppy, this could be a situation where I'd add to my Microsoft.
Right. Jay, you got anything here?
Occasionally I'll mention Microsoft, but mainly it's at a price point where, for me, being more into options, it's almost a bit boring. Being that you've got to outlay a lot more in the options chain to do anything. So yeah, my focus has been more on like NVIDIA and stuff that just has a little bit more range. But that's going to be to each their own. I mean, I love range. I love things that make big moves, and I'm a percentage guy. I like to make big swings. But to say that about Microsoft, I guess you could almost use it as more of a parking lot for investment purposes. It's great for investing in. It really is. It performs very well over time. But for traders, it's just a little bit on the boring side is all.
Larry, just let me add on that one for both of you guys. Like, if you were like a regular person and you could buy like one stock, like a kind of a Microsoft-esque type, the next Microsoft or whatever, what would that be?
I'll start. NVIDIA.
Yeah, go ahead.
Just straight up NVIDIA. NVIDIA is holding up so much. I mean, they're what, 8% of the S&P right now is NVIDIA, something like that. It's
okay.
Yeah,
NVIDIA,
hands down.
I mean, that's a loaded question, because is it like, just buy it and stick it in your safe and forget about it, or
right? It is loaded.
Yeah.
So there's a lot of variables to it.
But kind of, yeah. Yeah, I mean,
Yeah,
yes.
you could say,
yes. I mean, like if you were like if when I was a broker like Microsoft, if you would have bought it, you would put all your clients on Microsoft instead of try to, trade, British American tobacco every time
Right.
someone announced a takeover rumor. My clients would have billions of dollars. Instead, they bought British tobacco and they're, stocked at 20 instead of, split adjusted 2000 or whatever, right?
Yeah.
I think you've always got to be looking at scenarios and, having possible things in the back of your head. One of the scenarios that I'm very cognizant of as a possibility is, and we're writing about it in tomorrow's newsletter, is that all of the CapEx spending on AI by the Magnificent Seven companies has trumped consumer spending and is what is holding this market up. And at least for the meantime, making valuations not matter. What if that is true, and that's an if, what the implications of that are, I do not know. I think you don't want to avoid the Magnificent Seven names. I think you don't want to avoid the companies that are, making money on the spend. But you also want to be careful. What I also think is there are a lot of names out there that just we're in a target rich environment that you don't want to bother with. I was just on Schwab Network this morning talking about Workday. It was just like, who cares?
What's Workday?
They do agentic AI for companies, HR, financial stuff, and it's like, I mean, who cares with all the other stuff out there, unless I really think they have potential to be a leader in agentic AI. I don't care.
It's like the parking lot. I mean,
So you say
Microsoft.
Nvidia too, then? You say, like, if you were going to have to buy one, hold your nose, put it in a safe, never look at it again, message in a bottle, it would be Nvidia too, Matt? You don't want to you don't want to get stuck in that. No?
So put it to a time constraint. You talking about today or have bought earlier? Because I wouldn't.
Let's say, like back in the day, if you had a kid, you'd go buy a field,
yeah.
you'd plant the forest with trees. 18 years later, you sell the forest and you whatever for your kid, right?
Yeah,
One of those.
I guess if I had to, it would be NVIDIA.
Yeah?
I mean, I've said it before, I'll say it again. There's probably no real alpha in buying NVIDIA here.
Yeah.
But if you were a buy and hold investor, I think NVIDIA is a must own. But then you've got to have, other stuff. But
yeah, it's a good question. I love NVIDIA, right? But I lived through that 2000 boom and bust cycle where tech stocks had their comeuppance. I love NVIDIA, but if we did this podcast in 5 or 10 years,
exactly,
I think that Netflix and Spotify are still going to be, when I look at,
definitely,
I love Netflix.
Like sticky, like, my wife and I, we always talk, we'll sell the house before we'll get rid of Netflix.
Put up the Netflix, man.
I mean?
Pull up the Netflix, man.
We've got,
Netflix?
Yeah. Peaky Blinders, man.
We've got
I could talk about that forever.
They've got the NFL and then Spotify. We've got this family plan where like all of our kids and, we've all got these playlists and stuff. And, I just think that those are two sticky businesses that, in 10 years, if we do this podcast, I think Netflix and Spotify are still going to be,
All right, write that down, Pat, and we're going to have Larry back in 2 years.
Yeah, like I just said earlier,
I said 10 years.
I'm watching The Crown, man. So I'm on Netflix, like every night.
Well, we can.
They're doing
in the old age home.
Listen, they're doing the NFL. They've got the WWE.
Yeah.
They've got this great show called Mobland that I think I've watched.
Oh, dude, it's the best show.
God, 8 times.
Oh, God, I love Mobland.
It's a great show, but I just think that
I've been talking to Matt about that, by the way, Mobland.
Yeah,
I like consumer names.
Yeah, I love Netflix. I think that's a good call.
Yeah.
All right, Larry, anything else you want to say? I think we're going to all be jumping here at some next few moments.
Yeah, well, I appreciate you guys having me on. Always glad to share the screen with you. And longer term, I'm bullish. I think we finish the year higher for the
Blue
S&P.
chip daily.
Yeah, blue chip daily. But like what Matthew said, I'm really super cautious over the next 4 or 5 weeks. And it's like anything. I live in New England, and right now we've been at the pool every day for the past 30 days. But
Right.
come February, when it's 0 and snowing, you go through hot cycles and cold cycles. And if we look back historically, and we see that September is the worst month in the S&P 500 since 1950, and then on top of that, you've got this micro focus on the Fed. To me, it's just a time to sit on a little extra cash. Matthew's got the hedges. I'm not super aggressive. If I think there's higher volatility, I just want to focus on staying in one piece. And then once we get through that, October, November, and December, maybe put the pedal to the metal again. But I think you can't drive a race car full speed all the time. You gotta sometimes go into second gear and coast.
All right.
There's a reason they have brakes on a race car, and that's the best thing they do is stop.
Yep.
All right, guys, let's end it here. I got to do some wedding stuff.
Congrats.
Yeah.
Matt's daughter's getting married this weekend, Larry.
Yeah.
Who's getting married?
Matt's
My
daughter.
daughter's getting married on Saturday.
Oh, congratulations.
Thank you very much.
Matt's going on the honeymoon too, Larry. He's going along with, right?
No, I'm definitely not.
Costs a lot of money.
There you go.
See you guys later.
See you. Thanks for joining us. We'll see you guys next week on Wednesday. I think we're doing, aren't we? Just to clarify.
Think so.
We'll figure it out.
Yeah, we'll figure it out. We'll see you guys next week anyway. Thank you.